Hello and welcome to Buy, Hold, Sell, brought to you by Livewire Markets. My name's James Marlay and we are nearly over the line on 2021. It's been a tough year. There's been highs, there's been lows, and who better to talk about highs and lows than James Gerrish from Market Matters and Junbei Liu from Tribeca. Great to have you both with us today.
Thank you for having us.
Thanks for having us.
Now, readers, get your pens out. Before we get into the show today, I've got a little quiz for you. And no cheating, no Googling on the questions here. Get out your pens, write down your answers. What was the best performing ASX 200 stock in 2021 year to date? What about the worst performing stock? Have you got that one? Best sector, worst sector. I want you to write down your answers and I'll tell you at the end of this video. No Googling. James, if you had to describe markets in 2021 with just one word, what would it be and why?
I think I'd use the word rotation. I think it's been a year where we've seen huge changes around the thematics that investors have backed, sectors that investors have backed, and stocks. And all of those things have come in and out of fashion in pretty aggressive periods over the last year. So rotation would be my one word for 2021, Jimmy.
Okay, great. Hold that thought. Junbei, what's the word that you'd use to describe markets in 2021?
I would still call it successful and post a very successful 2020 as well. We had the inflation fear, we had many virus variants. We have the Omicron, and we've got we got the trade war, we got the geopolitical risk. We had all these issues, and yet we continue to push all-time high, and that's been incredible resilience in the market. So yeah, successful.
So Junbei, positive surprise this year. Well, it turned out okay. What was the most unexpected thing that happened in 2021?
I think, as I talked about before, most unexpected is how resilient the market has been. With all these, given the pandemic, it's been a health crisis. We never really fully resolved the health crisis yet, and we keep coming out with different variations of the virus, and yet the market keep pushing higher and higher, and it's incredibly resilient. And this is at the time where we, have all these fears about inflation and things, and the corporate earnings recovery hasn't been exactly smooth. So just how resilient the market has been. And it does give you a lot of confidence in terms of where it heads over the next 12 months.
Okay, James, what about you? What was the unexpected thing that happened in 2021?
Junbei just stole my thunder in terms of resilience. So I completely agree that the market has been incredibly resilient over the last 12 months or so. I think the other thing that's really been interesting this year has been the rise of crypto and the validity or the acceptance that crypto has generated over the past 12 months. I'm not saying it's the right thing, but that sort of, the number of people out there who are now involved in the crypto space has really caught me a little bit by surprise about the speed of that. So the resilience of markets and the rise of that thing called crypto.
Actually, that's really interesting, right? Even Commonwealth Banks caught on to it. They're allowing, providing services like custodian stuff for the cryptocurrency space.
And you think about how they, what validates something is its acceptance. So, I think that's really increased, aside from what Warren Buffett has to say about crypto and the comments that he makes about it. That acceptance that's really built over the last 12 months or so.
And it feels like it's still gaining momentum.
Yeah, absolutely. And I think there's going to be more to come. I don't know what crypto is going to be successful. It's really hard to tell, but I think the premise behind it has foundation.
Yeah, interesting. So James, this is the one that hurts, and we all have them. What was the worst performing position you had this year? What went wrong? And what's the future for that position? Is it on the chopping block, or are you going to try and resuscitate it?
It's on life support at the moment, so we're still holding on to it. Our worst position for the year was Service Stream, SSM. They had a number of things that hurt them throughout the past year. Firstly, it was around the NBN and the weakness in the NBN space. They also had some big labour issues. So obviously COVID has been difficult to get people out on site, and that really hurt Service Stream. Overall, that had a negative impact on margins, and they saw multiple downgrades as a result of that. Ultimately, they then raised capital to buy Lend-Lease service business, which I think will prove to be a positive acquisition. There's just some pain to wear in the medium term. So we've kept a small position. Yep. We'll upweight it once we see signs of a turnaround. So I think the position was down 50% this year, so not a great one in a rising market, James.
Yeah, tough one to hold. Junbei, same question for you. What was the one that kept you up all night, the one that gave you the sweats? the one that you didn't want to look at when you turn the screens on in the morning?
Look, this one is, I wouldn't say it keeps me up at night. If anything, I think it just provides a good buying opportunity, and it's more of a long-term position for us. So the stock is Ramsay. Look, share price has done nothing since the recovery of the pandemic, pretty much. It obviously private hospitals, and it's meant to play that reopening theme, or when the earnings recovery, people finally, there's a long waiting list, people coming back to the hospital and things. But of course, we know we had many lockdowns and shutdowns that's affected its recovery, and then its offshore operations in UK and France continue to be impacted by, or France especially, continue to be impacted by high rates of infection over there, and the business is in good balance sheet and things. It's just the recovery slow, and now it's been hit with something else, which is lack of availability of nursing staff. So the staff cost is going higher, and then its hospital beds yet to return to full capacity. But it will, simply because on the back of reopening, the queue of private hospitals is enormous, and earning will come back. It's just taking much longer than we initially expected. We all thought the COVID recovery will be straight line, and clearly in real life there's many variations, take time to come back, but it's a good business. We're happy to sit there, a bit of a bottom drawer sort of stock.
Well, let's get out of the hospital, out of the operating theatre. Let's go from flatline to heading north. What's been the stellar stock in your portfolio? What did the heavy lifting?
Oh my goodness, there are so many.
Just quietly.
But let's talk to this one. So this one, we actually have held for a very long time. That's Pinnacle. Yeah. So just incredible management team, incredible diverse group of portfolio of assets or fund managers. And one thing we learn about fund managers is that they all have different styles. Some grow some value, and some have a bit of mix, and some doing different things, quant or fundamental. Sometimes certain micro condition will work for others and others doesn't. So and for Pinnacle, because they got a group diversified portfolio, they actually as a group, they actually contributed very strongly. And because Pinnacle's got such a strong distribution team, and they actually have grown those managers significantly under their umbrella. And now they actually bolt on quite a lot of new managers in recent times, and the farm is growing enormously. So this company has done incredibly well, and we think will continue to do very, very well going forward.
So you're hanging on to your position in Pinnacle?
Absolutely.
Okay, James. Out of the many stocks that went up in your portfolio in 2021, which one would you like to do? Which one did the heavy lifting?
I think the one that springs to mind is Altium, which has been a really strong success story in 21. I think it's been a volatile ride, and just like June Bay's pick in Pinnacle, which is I completely agree with the basis or the foundation for owning that position. Altium has had some ups and downs. They obviously had a takeover offer from Autodesk over in the US that they were pretty adamant in rejecting, and they came out and had some issues around margins and resetting market expectations following that. But they've done a really good job. They had confidence in their business, and it's really good to see an Australian company with such a key service product on the global stage that is being sought after. So, for me, Altium has been a great success story this year. I think it'll continue to be, and that confidence that management showed in the face of high volatility and taking what seemed to be a really good offer at the time and rejecting it provides confidence in my view of the stock anyway.
Yeah, interesting. Good one. Alrighty, let's turn from looking in the rear view mirror, get the crystal balls, have a look at 2022. What are some of the tailwinds and headwinds, or pick a headwind and pick a tailwind that you think is going to, move markets next year or have an impact, something for people to be aware of?
Yeah, I think the two things are interrelated. So the things that I've looked for over the last 12 months is the rate of change in money supply, which has been phenomenal since the pandemic. So in 2020, the rate of change in money was about 25%. If you look back historically, you see about a 5% change in money supply. Coming out of the GFC, we saw a 10% increase in money supply. Coming out of the pandemic, it was it's unprecedented at 25%. So that obviously underpins growth, which is positive for corporate earnings, and we've seen that corporate earnings come through very strongly over the last 12 months. But it also has other ramifications that I think we'll see coming down the track. So, cheap money out there, huge amounts of liquidity. At some point, that will create bubbles, and it will force central banks and regulators to come into the market and perhaps stifle things more than they would have otherwise. So the last time we was on with June Bay, we talked about inflation being transitory or not. And I think that's going to be a really key risk for the markets going forward. I know we've spoken about it a lot, and it's well known by the markets, but if we think of a risk going into the next 12 months, it's certainly that.
Okay. Do you want to, I'm not going to hit you for a headwind or a tailwind stock, but maybe a company that you think rides the tailwind next year?
So if you think about headwinds and tailwinds, then if the headwind is around rising interest rates potentially at a higher rate than the market's expecting, then you need to be conscious of these high valuation growth stocks. So I'd call out WiseTech, which is a company that the market absolutely loves. It's trading on 23 times revenue. It's growing sales at 20%, which is great. But if it has a hiccup in 22, it'll get slammed. If you think about the other side of the equation, you want to be holding stocks that are in value territory. So Virgin Money might be one to put on the radar. It's trading on 0.4 of book. It's had a tough 12 months, but the strategy around digitisation of that business, I think, has foundation, and there's not a lot baked into the cake. So I think expectations going into 22 is going to be really important. What's built into stock prices already?
All right, we'll finish with you there, June Bay. Tailwind and a headwind for 2022.
I think it's kind of similar to what James was saying, that in terms of tailwind, that our corporate earnings still strong, and partly because we sort of had a few hiccups in terms of reopening, and we had the lockdown and things, and now coming out of it, we should have a pretty good Christmas. Consumer looking very strong. They saved a lot of money. Savings rate really, really high. I think last 12 months they saved something like 10% of the GDP. Normally they save 2-3%. So it's a lot of money sitting on the balance sheet for the consumer, for the household. And the corporates are sitting on very, very good balance sheets. That's why we started seeing a lot of mergers and acquisitions and buyback and things taking place. So all of that means, economy, it's pretty healthy at this point. And if the new virus variant doesn't create any significant issue, that trajectory should look pretty good for corporate earnings. So that is going to be a tailwind for all of us around the world. We should see that continue to pick up momentum. China potentially stimulate a little bit. So all of that looks pretty good. Now the headwind, of course, all that easy liquidity James was talking about earlier, it's going to get harder. So we have so much money throwing it at all the economies because of the pandemic. These are emergency level of liquidity. It's not going to be here. Well, at least next year we're heading into the beginning of the tightening. So it's nothing to be alarmed about, but it just means the emergency level of easy liquidity, cheap money, it's not necessary, because look at the interest rate was so much higher before the pandemic hit, and our economy was okay, was actually on the way to recovery, and then the pandemic hit, we have to lower it, but now it's sort of still significantly below. So in a way we will be on the path to tighten. So that means it will just make it a little bit harder. Just means some of those, super expensive companies might be under a bit more pressure, especially if they don't make profits, and just be under a bit more pressure on that basis. So
with that positive corporate earnings, but maybe tightening of the easy money that's been around, is there a company that wants to thrive in that? Has you got a name that does well in that environment? Yeah, so I'm a little bit less macro when I start running my portfolio, because I always believe that in the next decade, yes, the interest rate will go high a little bit. It's not going to go as high as everyone says at the moment. It's going to be over the long run lower than what everyone expects, because we will, the productivity is going to be tough and all of that. So on that basis, it's going to be harder and harder to get growth in corporate earning. So the structural growth leaders or growth companies, they will still be highly sought after. But we do have we don't have a growth issue in the market, we have a valuation issue. So for the super ultra, spicy stock that doesn't make money and trade on very high multiple, they will be under a lot of pressure. So, but
in this environment, other growth companies, they might get sold off temporarily, and I'll be happy to step in to buy. Things like Seek, things like REA, they're expensive, but they're so much cheaper than some of the really high-end growth companies. But on the value end, when we talk to the cheaper cyclical company, you got to be mindful as well, because they may be very cheap, but a lot of time they're cheap for a reason, right? And the minute there is any hiccup in terms of growth or outlook sort of issue, these companies will get sold off very quickly. But some of the businesses will be leveraged towards a global recovery. Actually, normally I don't push mining stocks, but certainly recently a company like BHP has been sold off massively, and yet their peer, the smaller miner, specialized miner like copper and other things, has done so much better, just because investors are now sort of funding the big ones into some of the more hot area, and that could well reverse next year, because these companies are going to generate so much cash flow. It's going to be incredible.
Okay, great. Well, that's the highs and the lows from James and June Bay. Now, get your marking pens out, get your red pens out. I'm going to give the answers to our little quiz. Best performing stock in the ASX 200 was Pilbara, PLS up 170%. Superb outcome. The worst performer was Polynovo, down 65%. The best sector, this one stumped us all, was the telcos, up 31%, with Telstra doing the heavy lifting, and the energy sector was down 4%, and that was the laggard in the ASX. Now, if you get 4 out of 4, give yourself a pat on the back, hit subscribe, because we've got heaps more great content coming to you over the summer.